While the world is obsessing over the headlines, a silent, structural collapse is happening in the global supply chain and is entirely missing from standard macroeconomic forecasts. 70% of maritime traffic through the world's most critical energy choke point has just vanished. This is not a temporary shipping delay. It is a mechanical trigger for a global stagflationary shock that most investors are fundamentally misreading. We are no longer dealing with speculative price swings or transient supply chain hiccups. We are witnessing the physical upstream removal of energy and agricultural supply that is forcing a violent repricing of the global economy. To understand the sheer gravity of this moment, we have to look at the mechanics of the Strait of Hormuz. Right now, this critical artery is restricted almost exclusively to Russian and Chinese vessels. For everyone else, it has become a hard bottleneck. Energy transit data reveals that more than 25% of global seaborne oil trade, roughly 20% of total global oil consumption, and 20% of global liquefied natural gas trade rely on this single route. This is not transit risk, where a cargo ship simply arrives 2 weeks late. This is an upstream disruption where energy is taken off the board entirely. We have already seen crude oil surge 5% in a single day, while the European TTF natural gas benchmark exploded as much as 49% intraday following drone strikes on Qatari LNG production. At the same time, marine insurers are repricing war risk coverage, sending freight rates to multi-year highs. This creates a mechanical inflation shock that feeds directly into import prices across the globe. However, the greatest analytical error you can make right now is assuming this inflation shock will hit the entire world equally. The old strategy of modeling a uniform global macroeconomic recovery is dead. The structural risk of this blockade fractures cleanly across the Atlantic, creating two wildly divergent, yet equally dangerous, economic realities. In Europe, the situation is existential. The continent is facing a severe asymmetrical terms of trade shock that structurally mirrors the energy crisis of 2022, but with a terrifying new vulnerability. In 2022, when Russian pipeline gas was severed, Europe's industrial base survived by pivoting aggressively to seaborne LNG. Today, that exact replacement mechanism is under attack. The primary risk for Europe is no longer just standard consumer inflation. It is structural deindustrialization. When natural gas prices spike this violently, heavy industry does not simply pass the cost onto the consumer. They idle production entirely. This dynamic is already transmitting a secondary, catastrophic shock into the European real estate and construction sectors. To understand why, you have to look at the industrial chemistry of building materials. The production of steel and iron is intensely reliant on natural gas, which functions not only as a heat source, but as a crucial chemical reducing agent in the direct reduced iron process. When gas prices invert smelting margins, the supply of structural steel freezes. For the real estate sector, this creates a toxic convergence. Massive material input costs are colliding with historically restrictive European borrowing costs. The mechanical result is the instant destruction of project viability. Development pipelines freeze, structurally restricting future housing and commercial supply, which paradoxically keeps the cost of living elevated even as the broader economy contracts. Crucially, Europe is walking into this industrial crisis without a safety net. During the 2022 shock, European governments masked the true extent of job destruction through massive fiscal interventions, subsidized furlough schemes, and bailouts. Today, that fiscal space is exhausted. Sovereign debt burdens are significantly heavier. Without the safety net of aggressive government subsidies, the current energy shock threatens to convert what might have been temporary factory furloughs into permanent structural unemployment, as capacity is offshored forever. The United States, on the other hand, is playing a completely different macroeconomic game. Because the United States is functionally a net exporter of energy with deeply resilient domestic demand, it does not face the same systemic risk of supply starvation. The American risk is rooted in sticky, demand-driven inflation. Because the U.S. consumer remains resilient, corporate America still possesses the pricing power to pass the surging freight, fuel, and material costs down the chain. This heavily increases the probability that inflation will become entrenched well above the 2% target, creating a slow bleed scenario for the middle class rather than an immediate industrial collapse. But there is a secondary, silent vector building in the background that threatens both economies equally: agriculture. The Strait of Hormuz is not just an oil artery, it is the backbone of the global fertilizer trade. It handles an estimated 44% of global sulfur exports, nearly a third of global urea, 18% of ammonia, and 15% of processed phosphates. While energy prices move headline inflation today, a fertilizer shock operates with a lethal time lag. If these chemical inputs remain trapped behind a geopolitical blockade, agricultural production costs will surge globally. This creates a highly probable risk of delayed, severe food price inflation hitting exactly as global crop cycles demand these inputs, extending the duration of this entire inflationary wave long after the initial panic subsides. The precious metals markets are already screaming that something in the system is breaking, but the signal is deeply fractured. Gold, trading near an unprecedented $5,400, is performing its classic role as a hedge against fiat debasement and compounding inflation. But silver is revealing a massive systemic divergence. While physical Shanghai silver recently closed near $110, New York paper silver fell toward $90. This extreme $20 arbitrage gap is not normal market behavior. It shows that while physical supply in Eastern markets is exceptionally tight, Western paper markets are beginning to price in the severe industrial demand destruction we are seeing in European manufacturing. In the silver market, the fear of runaway inflation and the fear of a collapsing global growth engine are now in a direct, violent collision. This brings us to the final, inevitable endgame of this crisis: the labor market and the impossible choices facing central banks. When supply-driven inflation meets central bank constraints, the cost of rebalancing the system is always paid in unemployment. However, because the inflation mechanics are different, the central bank reactions will diverge massively. The Federal Reserve is trapped by the theoretical framework of the Phillips curve. The Fed cannot print oil, it cannot clear shipping lanes, and it cannot synthesize fertilizer. Monetary policy is utterly powerless to fix a physical supply chain blockade. Therefore, the only tool the Federal Reserve possesses to break the sticky pass-through inflation in the U.S. is the intentional destruction of demand. To defend their credibility, they must hold the cost of capital punitively high, forcing a margin squeeze on corporate balance sheets that inevitably leads to deliberate payroll cuts and rising cyclical unemployment. The European Central Bank faces a much darker dilemma. Because the European industrial base is facing a margin collapse and systemic supply starvation, the ECB does not have the luxury of keeping rates higher for longer. If the natural gas shock persists, the ECB may actually be forced to cut interest rates to prevent a systemic credit event and save the remnants of its manufacturing core. Even as headline inflation continues to print extremely hot, the global economy is rapidly transitioning from pricing in a temporary maritime bottleneck to pricing in the severe economic contraction required to break the inflation it caused. If this geopolitical blockade persists, the world's central banks will soon be forced into a brutal corner. Either completely abandon their 2% inflation mandates or explicitly engineer a global recession. The macro landscape is shifting faster than the headlines can report, and understanding these structural mechanical realities is the only way to protect your portfolio. If you want to master these types of deep analytical macro dives every single week and stay ahead of the curve, hit the like button and subscribe to the channel. Let me know in the comments below if you think the Fed will break inflation first or if inflation will break the Fed.